Okay, let's get it started. Okay, couple of announcements. One is that on Tuesday next week, one of my students, ex-students in NTU that I taught before, his name is John Lin, and some of you met him before. This guy. Shadowed right now, so you cannot see him precisely, but he is visiting Seoul. He just called me today. He messaged me today. He's visiting until Wednesday, and I said, can you come to my class and then deliver some guest lecture? Because he's the CFO of a venture company called Clinica in Singapore, as a medical big data company. So can you talk something, and give some lecture about venture finance? So he may come, okay, and talk to you in the early afternoon. If that happens, I will videotape it and then share it across the whole iCore students. And something he talks about will be in the midterm exam, yes. And then, your homework, right? Homework, due date is delayed until next Thursday morning, right? So, don't worry too much, you can do it, right? And what else do I have to say? Today's lecture, we have to start from here. Couple of things to address some common questions. One of you asked me, treasury bills and treasury notes and treasury bonds, are there some distinctions? Well, the distinction is maturity. Okay, treasury bill. If your treasury bill is maturing within 1 year, we call it bill. Treasury securities within 1 year maturing. If it is above 1 year and then going until 10 years, it's like treasury notes. Beyond that, up until 30 years maturity, that's called treasury bonds, right? Treasury bonds. And the name itself, it's not a big issue, but what is important is you have to match the maturity with your investment horizon. For example, if you are a hedge fund manager, a high frequency trader, like buying and selling the stock every second, right? Every second. Then your risk-free rate benchmark will be something in the treasury bill rate over here, the shortest maturity. If you are long-term investors, like Warren Buffett, holding it until 8 years from now, treasury notes will be your benchmark risk-free rate. If you are really long-term investors, like if you are investing in infrastructure, like building bridges or tunnels, right? All those things, treasury bonds would be your benchmark risk-free rate. Okay, so that is it. And another thing I have to tell you is, the CFA Research Challenge, right? CFA Research Challenge. I uploaded those video files of presentation on the website. I shared it on the, the class web page. But if you cannot find it in the class web page, you can always go to my web page over here. I say Google and right. Here is my website. Yeah, hello. research challenge above here, right? So you can see those pictures. Hello, and these guys, right? And what they did, right? This is meeting, talking to the team Indonesia, I think, or SKKU guys, and this our mentor, Dr. Song Changwan, and then here are the judges, and then you can see the student presentations, right? For Korean teams over here, right? And then Philippines team over here, and then see how they did it. Right. So go ahead and watch these things. Okay, go ahead and watch these things. Regional. This is Asia regional preliminary round in the morning, and the other 5 are regional final that took place in the afternoon. Okay, Korean teams did very good this time, much better than I anticipated. But still, I thought they were number 2 in our group. Okay, Peking University MBA guys passed it and then went to the final round, but the team from Philippines got number 1 prize, and then they're going to the Wall Street this month. Okay, and I want you to pay attention to how they present in their body language, and then how they say it, and their contents, right? Their delivery of ideas, right? The valuation technique they did it. Those things are very important. But also I want you to pay attention to the judges. What questions do they ask, right? There are 4 judges in each preliminary session like this. They're working hard, right? On determining how you did, good or bad, right? These guys, they come from all different countries. They're not standard English speakers, okay? In our preliminary, one guy was from France, another guy from Australia, another guy from Hong Kong, another guy from Philippines. And they are not speaking standard English. Their pronunciation, accented. So you may complain, oh, our professors don't speak standard English, they've broken English. Bah, I hate it. Well, that's the reality. If you go to this, global competition, everybody speaks broken English. So, what shall we do? And then the question here is the French speaks in French accent, for example, what is the cash flow here? And then this and that instead of this and that, right? And you still have to answer those questions. You have to understand it, right? I want you to play some of these, especially India teams, and then try to understand all these different accents, okay? British accent, Australian accent, Korean accent, one of them, right? Right, so you guys have been trained so much in the standard English, but we have to get used to this kind of things. There are two choices. One is giving up. Oh, I don't even understand perfect English and standard US English, so I'm going to give up everything and just focus on domestic market. No, I say no. The other approach is what? Free up your mind and let's break the English together. You speak broken English, I speak broken English, let's break it together. And then lower it down your expectation, okay? And then just say it out. That's it, okay? So familiarize yourself with this environment because, right? Once you get a job and then find jobs, hopefully in 10 years down the road, find jobs in Singapore or Hong Kong, you will work with these people. Okay, more likely that you will work with people people from India, people from Philippines, people from Singapore, and speak broken English anyway. Instead of meeting the standard English-speaking person from the US, okay? That's the reality, okay? So don't worry, just familiarize yourself. Number two, I-core questions, right? When you do the presentation in the I-core, right? I will ask questions, just like what these guys are asking. So pay attention to what kind of questions they ask, okay? If you don't hear it, catch it correctly, work it out together with your teammates, right? What was the question? What did you hear? And find out, okay? Very important points. Their point is exactly coming from the industry. They are hedge fund managers or mutual fund managers and then analysts in the real world, okay? So, get ready. And the next thing is that this is finance area competition, and marketing area competition is also there for you, which is called P&G CEO Challenge. And I'm going to meet Professor Shim Suok right after this class and then talk about this possibility. There they will also have country level challenges, Asia regional level challenges, and global level challenges, and then the winner meets the CEO of Procter & Gamble. Okay, so that's fantastic opportunities. Another thing I want to highlight is that recent research in behavioral finance, they find that, the finance industry notoriously very closed in terms of selecting people, recruiting people. Usually, because it's money issue, they trust the family most, right? Your sons and daughters will never betray you, and then the relatives. So this kind of connection mattered a lot more, okay? But the recent paper in Top Journal finds that those new recruits or fund managers coming from non-rich families, right? Middle class or lower social status class, right? Those guys selected perform better. You have to widen your scope in selecting the people, okay? And then for this purpose, right? CFA Research Challenge, all these kind of things are very meaningful, I think, okay? Opens up the chance for everyone, okay? So why not we try it, okay? That's the idea. Hope you like it, yes. And then, another part is this. Did I go through this part in your last lecture? By the way, I uploaded the last class lecture on the webpage, so you can watch it, right, and catch up with it. But here's the thing. At one point I said, the Hyundai Motors, right? Hyundai Motors risk. Which part of the risk do they care? Especially your well-diversified portfolio managers, like KIC guys or National Pension Fund. What they care about is their total risk of their portfolio. Total risk of this market portfolio, including thousands of different stocks. So when they look at Hyundai Motor, one specific company, what they care about is how much does this Hyundai Motor make my market portfolio more risky or less risky? That's my issue, that's my concern. If it is making my portfolio more risky, I'm going to punish him more by assigning higher beta, kind of thing. So beta, market risk measure, is a contribution measure, we say it. How much the Hyundai Motor contributes to the risk of total market portfolio risk. Okay, what's the contribution? That's measured by beta. Why do we say contribution measure? Here's mathematical reason why. Here, okay, this is beta of Hyundai Motor, right? Beta H. And that is defined in your statistics, right? Beta is defined as covariance over variance. Make sense? Covariance over variance. There, your variance has to be the market index return, RM. You can take a picture of it, okay, if you like it. Yes. Thank you. So, covariance is the return between your company's return and market return. Yes, and I think I'm, getting more popular. Makes me happy. Anyway, so covariance over variance, and then we're gonna get back to this one later. How do you interpret this beta is an issue? And let me go straight into the definition and then regression right now instead of waiting until later. Okay? So, the beta concept comes from regression, right? You learned about regression in where? Statistics 101. So who invented regression for the first time? Who invented regression for the first time? No? Nobody? It just came from the heaven? No. Yesterday, right? What was the big news in natural science? Right, there was a picture about black hole, right? Astronomers have been working diligently about it. Now, how is it related? 200 years ago, there were a lot of astronomers and mathematicians, right? And there was a comet in the universe called Ceres, right? And then there was a festival, kind of competition among these astronomers, and said, look, Ceres is coming, right? Can we devise a way to estimate the trajectory, 궤도, right? As it comes, right? So whoever comes up with the scientific idea, most scientific idea, will get the first prize, okay? And Carl Friedrich von Gauss won the first prize over there. And that was the beginning of regression. Did you learn about it before? No? How did he do it? He looked into the sky. Okay? If he was a musician, the singers, or the poets, what would he say? If he was Korean, he would say, 저별은 나의 별, 저별은 너의 별. Right? If you were English singers, he would have said, what? Starry, starry night, da 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 da. But he was a mathematician. He said what? Here are the stars. And for mathematicians, we are living in a very simple world. Everything is in the XY plot. Okay? X and Y. The thing is, this Ceres, I don't know where the heck this will go through. But I have some good idea about the neighborhood stars that will closely pass by. This will closely pass by in this two-dimension site. Okay? Two-dimension map. So maybe I need some other. I would say is that these stars will be the ones that Ceres will pass nearby. Okay? So the question becomes, what is the straight line? Let's say y equals a plus bx, right? What is the straight line equation? Who says that it's the minimum distance, minimum squared distance from all of these stars that I picked up? This is a sample point, right? Sample point, and then the minimum distance linear line I'm going to find out. That's the definition of linear regression. Make sense? Yes. Now, what am I trying to say?
So the slope term over here, okay, slope term over here, that's this beta. Make sense? Right? Slope term. Rise over run. Rise over run. This one, run part is variance. Okay, variance, because it's a random variable. Okay, it's not deterministic. Of course, the star is deterministic, but when it comes to those returns, all these other statistical things, it's going to be random. So let's say dispersion is variance, and the rise part will be covariance. Covariance of y variable with respect to x. It's not about just simply y's variation, but it's covariation with respect to x. How much does it move together? How much sensitivity is it moving? That's the idea of beta. Make sense? Right? So let's bring that idea over here. Okay, over here. Hyundai Motors return will be on your y-axis. Let's say RH. Your market return will be, index return will be on your horizontal axis. So in your homework, you have to run 20 different regressions. 노가다. Right? It's like too much work. I know. Painful. You're going to learn a lot. Okay? So you will run a lot of regressions over there. You have to be clear about x-axis, S&P 500 index return over there, and the y-axis, your company's stock return. Okay? Over there. And then, for all different companies, just draw XY scatter plot. Scatter plot in your Excel. You can do it one by one. Or you can use multiple regression function in your Excel add-ins, or you can run it with your Python or R, whichever it suits you better. Fine. Okay? Do I always have to generate a scatter plot? Nah, that's just a pictorial way of showing it, and then you can easily click and choose some linear trend line, and then show me the equation in that trend line. You will obtain this guy. Okay? The regression line equation. Now that's Hyundai Motors regression of beta. We call it characteristic line. Anyway, the next one is a special case. I would say, what if I regress market return onto itself? Okay, let's say instead of Hyundai Motors, if it is market return on your vertical axis, and then market return again on your horizontal axis, what will happen to your regression beta? Has to be 1, right? It will be 45 degrees line, everything lines up over here. Identical, right? 1. So market beta, by definition, it has to be 1, and that is shown over here. Market beta, okay, has to be 1. And then we're trying to get to the idea of contribution measure. Why do we say Hyundai Motors beta is a contribution measure to market's total risk? Now, market portfolio risk. Now expand it into this definition of covariance over variance. And then you see that this one is Rm, and then this one is also Rm, right? And then this is S&P 500 index return. I would say then this happens, right? Index return is nothing but, I would say, weight of 1, R1 plus, You have n different securities in your market portfolio. For example, S&P 500 different stocks in the US market. They all have their own return, which is random. And as a portfolio manager, you have different weights for different stocks. That's something you can control. This is deterministic, whereas your returns are random. Okay? Random returns, weight, that's this guy. Make sense? So what do? Stick this in, right? And then rewrite it. Okay? Keep your hands busy. And then it works like this. And the second term, comma, right over here, Rm stays the same. Don't try to expand this guy and trouble yourself even further. Cross multiply, crazy. But the idea is this. Let's use the property of covariance, because covariance of ax plus by and z, those random variables, then covariance expands like this. A times covariance xz, b plus b times covariance of yz. Make sense? Okay. So let's use this property to here, and it becomes what? Covariance of first the securities return and market index return over variance of market index return. Make sense? Now, the weight got out of it because it is deterministic, not random. Okay? We do the same thing over and over again for n different stocks. Covariance over variance. Now what do you see? If you take a step back, then you will realize that, oh, this is nothing but beta of security 1. And with weight. And plus plus plus, beta of security n. Make sense? Right. That has got to be market beta of 1. Now what do we find? Well, let's say this guy is Hyundai Motors beta. Okay, Hyundai Motors beta contributes to market risk. Make sense? Contributes to market risk. That's why we say beta is a contribution measure to market portfolio risk. Right? To the extent the Hyundai Motor makes the market portfolio riskier, the beta will be higher, and then we will have a higher required rate of return. So that's the idea. Okay. Now, right, where did we stop? Did we go through this part? Yes, right? And then did we go through this part? Yes. We did everything. Yeah. Capital market line. Did we go through this part? Yeah. Here we ran all different possible 1,000 portfolios based on 3 different stocks. Only 3 different stocks. I gave random weight summing up to 1 for 3 different stocks. Can we expand it into thousands of different stocks? That's crazy. I know. But it has to happen like this. Thousands of different stocks. They will be dotted out upon this one. All different portfolios. But there will be some barriers or frontiers like this. What you see on your horizontal axis is the standard deviation of portfolio returns, standard deviation, right, volatility of your portfolio. And then vertical line, that's the expected return of your portfolio. Right? Now, your umbrella shaped or this hyperbola kind of things, you see a minimum variance point over here. This is standard deviation or variance. You can interchangeably use that terminology over here. So that this point, okay, is a portfolio with minimum variance. Make sense? Minimum variance based on all risky assets. Okay? And then these dots and this red line, curve, red curve, this is called efficient frontier. Efficient frontier. Because it is achieving efficiency, okay, with the same degree of risk, it is achieving the maximum degree of expected return. Isn't it efficient, right? Minimum degree of risk that I hate, the maximum degree of expected return. Constrained maximization is happening. Optimization is happening over here. So these points are based on the risky securities only. Now we introduce risk-free asset, treasury bonds. Then we have interesting thing going on. We can split our money into risk-free asset and risky asset. Two funds theory happens. There are two kinds of investment: risk-free and risky. When it comes to risky assets, how can we compose our portfolio over there? Well, that is the point where your straight line gets tangent upon this efficient function. Okay, that will happen. And then your portfolio will be formed by then. Your portfolio will be formed on this straight line. Okay, with the introduction of your risk-free asset, your frontier gets expanded to this straight line instead of red lines over there. Okay. So at this point, your portfolio is 100% on treasury stock, treasury security, right? On this point, you are 100% invested on market portfolio. In the middle, like 50-50, that's 50% on risk-free, 50% on market portfolio. Okay? You can think about portfolio weight within 1, okay, 0 to 1, okay? 0 to 1, portfolio weight, and 1 minus weight for risk-free within this straight line. How about this line? That your weight is over onto this market portfolio and minus upon risk-free asset. What do you mean minus weight on your risk-free asset? That is borrowing at risk-free rate. Instead of putting your money into risk-free asset, you're borrowing at risk-free rate like any hedge funds with reputable hedge funds does, and then put all the money into the market portfolio. That's this point somewhere. You are leveraging yourself, okay? Leveraged position. Now, what can you do with that? Tell me your risk preference, and then I will give you the solution for maximum expected return that you can achieve. Okay? As long as I can find out your risk preference, I can give you the optimal solution for your portfolio construction. That's the message over here. Okay? And then the slope of this line, okay, is this one. Watch out, this is different from regression line, okay? Regression or Gauss story is different from this one. It's capital market line, this straight line over here. And that equation, we show the relation between expected return of your portfolio and the total risk of your portfolio. Remember, this is about the portfolio, not just each stock, okay? Your portfolio. Your portfolio risk is x-axis over here. And then your portfolio's expected return is on the y-axis. If your portfolio has zero risk, by definition, that has to be risk-free return, okay? Because your government, is free, it pays. Then the question becomes, what about the slope, right? The slope. That ugly term is called the Sharpe ratio. Okay, Sharpe ratio, Sharpe ratio, I don't care. Nobel Prize winner, okay, Stanford. And then it tells you this idea, okay? Tells you that how much of excess return can you get in your portfolio? In excess of what? Excess of risk-free asset, right? How much of an excess return can you get by taking one more unit of risk in your portfolio? Okay? So would you like to have higher Sharpe ratio investment strategy or lower Sharpe ratio investment strategy? If you're forming some portfolios. If you're forming some portfolios, you want your Sharpe ratio to be higher, right? Taking the same risk, I want some higher excess return. That's the idea. Okay? Sharp ratio, very important concept. And then the big assumptions in the follow-up, assuming the diversification costs nothing in terms of transaction costs, and that all assets can be traded. The limit of diversification is to hold a portfolio of every single asset in the economy. This portfolio is called market portfolio, and the consequence is that individual investors will adjust for risk by adjusting their allocations to this market portfolio and riskless assets such as T-bill. Right. Right. So that's that. Any questions so far? Yes.
From the future market sigma
Sigma is the, yes, market portfolio is?
is that from the historical data?
Is that from the historical data? Ideally, this one has to be forward-looking, which means historical data is just one estimate of going into this, using for future purpose. The best one we can get is based on historical data only. Right. Market portfolio. Yeah. So still, usually in our level, it's based on market, the historical level data. Right.
So when we are projecting the expected return based on historical risk, is there any models that can also project the future risk of the market?
Very important question. People come up with those kinds of research in asset pricing. If you go to the more advanced degree, right? Based on some more, we call it. We'll talk about those issues later on, a little bit about equity risk premium and that kind of ideas, right? Our limitation right now is based on historical data only, right? It's that. Good. Yeah. And other questions? Right. Good. Now, here. Okay. The next concept we're going to go through is called equity risk premium. Equity risk premium, or we call it market risk premium. Doesn't matter. For market portfolio, how much of return premium should we expect is the issue. Okay, how much of a premium should we expect? We are in the exercise of estimating this required return when we invest in any risky asset, risky securities, right? How much should be our required return to compensate for the risk that we take? The thing is, we start with the benchmark risk-free rate, and we are adding some risk premium going into the future. Now, the thing is this, okay? Equity risk premium. Let's think about how much the investors in the market would like to get above risk-free return for risky investment in well-diversified market portfolio. Moreover, it should be forward-looking as we go into the future. The question is, can we observe a true market risk premium? Okay? Can we observe true market risk premium which is really forward-looking? Okay? And the answer is no. Right? Just like the true value of a firm is not observable, the true market risk premium is not observable to our eyes. The whole discipline of asset pricing delves into this kind of issues, and it goes together with your spirit, spirit of your questions, by the way. If you want to speak up. All right? Now, so now what? Right? Now what? Well, just like the true value not observable, risk premium not observable in our eyes, we have to estimate it. Estimation is a statistical way to getting to some unobservable true number called parameter in statistical jargon. So then how is the question? We have two different approaches. One is historical premium, the other is implied premium about this. So we'll go through historical premium first and then go to implied premium. Okay? Implied premium is more, how do you say, faithful to the idea of forward-lookingness, but it's still an estimation because we need a lot of assumptions about cash flow and its growth. Now, historical risk premium, it's about looking back in history, okay? Looking back in history and figure out the average of market index return in excess of risk-free return, okay? In excess of risk-free return. And then hope and pray that the excess market return will be the same in the future. Hope and pray. What if not? We don't know. Now, historical risk premium is that stocks have historically earned over riskless securities. Two different ways we have it. One is arithmetic average, the other is geometric average. We look back in history and we calculate how much the market index has been performing period by period, and then how the risk-free investment has performed period by period, and subtract, okay, get the difference, and take the average. That's arithmetic average. Okay? Geometric average is different. We are using the concept of compounded average. We just need two time points, beginning time point and then ending time point, and then what is the compounded average growth rate that justifies this growth? For risk-free asset investment and market portfolio investment. Okay? We just need two time points and then solve for the compounded growth rate. Now, practitioners don't agree on the premium. It is sensitive to how far back you go in history and whether you use T-bill or T-bond, whether you use geometric or arithmetic averages, right? So the table over here shows two groups of historical premium. One is arithmetic average, the other is geometric average. And then in one group, we have two subgroups, which is stocks, market index return minus treasury bills, which is about short-run investment, and the stocks minus treasury bonds, which is about long-run investment. Okay? The same thing for geometric averages. What you see on the vertical axis is different lengths of sample period. Okay? Different lengths of sample period. 90 years, okay? Tracing back 90 years, 50 years or something, and recent 10 years, right? So, if you have to choose your historical risk premium, which one will be better? This one or that one, that one? Number 1, 2, 3. Number 1, please raise your hand. Number 2, please raise your hand. Nobody. Number 3, please raise your hand. Okay. Why number 3? Why number 3? Why number 1? Why number 1, by the way? Sample size is bigger than the other. So the standard errors will be smaller, less noisier, right? You have more precision. You are more precise in estimating. So the intuitive idea is like this. Okay? I'm trying to guess or estimate how you would do over the next, I don't know, year or something. Each and every one of you may not say, you or you, right? How would you perform in the next year? Well, that partly depends on your history, how you performed, right? Your parents looked at you and observed you throughout your life. Ever since you were born, and then how you're crying and laughing and then doing something good or bad, right? Versus me, I observed you only the last 1 month. Which one will have better? Your parents versus me. Which one will have better idea about what you will do for the next year? Me or your parents? Your parents. Your parents have seen you for a long time, ups and downs, and have good idea of where you will go. Me, I've seen you only the last month, and only thing I know is that you are working hard. Maybe because it's an on semester. I don't know what the heck you do in your winter break or your summer break, your party, something. I haven't watched it. Right? Good times or bad times. My estimate about you is a lot noisier. Your parents, longer time history, have more precision about you.
I have a question. I think, isn't it be more precise with 2009 to 2018? I mean, I have different opinion. Because from 1928 to 2018, yes, it has big sample size, but the economic trend has changed so much between the century. Like there was a wars, World War II, or the third industrial revolution, oil show, and the financial crisis. And every these events is changing the way people think and the trend of the policy or the global trends of the industry. And now is the era of fourth industrial revolution. Then wouldn't it be more precise to just reflect the recent 10 years?
So you're bringing more assumption over here. One more assumption is that there seems to be some kind of a trend or a short-run trend or short-run momentum kind of thing, inertia that is dominant within this next couple of years or something, right? We are trying to get away from that and then try to ignore those. We try to stay away from those transitory trends like that. Okay. The thing is, fourth industrial revolution. By the way, what is that? The concept itself, right? Is everybody is questioning, right? It's a good marketing buzzword these days, they say, and nobody really cares about it. Fusions or the integration of all these technologies, yeah, that is sexy, that's good. But wasn't there that kind of technological innovation in the past? Internet bubble period, we had that. And then Tron kind of tech bubbles, we also had it in the 70s. Is it going to be exactly the same? We are not saying that it's going to be exactly the same, but there were some times like this before. Sometimes like this before. Right, so that's the general idea about here. And every boom time they said, this is a new economy. Really, this new economy cannot be explained by past. But a couple of years later, we realized, that was a bubble, right? We get back to normal. So that's why we say, this is longer time history is better to have more precise idea about what will happen in the future. The thick box, I try to say this one over here. Okay? Alright. You estimate best guess of market risk premium is 7.93% based on the 90 years data. But are you sure that the true market risk premium will be 7.93% looking into the future? And the answer is no. Okay. Now what is the question? It's just an estimate with some noise. Okay, with some noise. And then let's say the standard deviation of this guy, Rm minus Rf over 90-year period, is 20%. Then the standard error is something divided by square root of n, 90 in this case. So it's going to be 2.1%. Remember in your statistics 101, 91% confidence band of your parameter estimate was plus and minus 1.96 times standard error. So notice x bar being 7.93%, 95% confidence bound would be 7.93% minus 1.96 times standard error and plus the same thing. So it would range from here to about 3.8% to 12.05%. So one standard, 95% percent up and down. It's 8% difference. Okay, what is your precise number of market risk premium going into the future? It could be anywhere between about 4% to about 12%, even though we said 8%, something like that. Okay, very noisy. Well, what about if we have, if it shows this guy, 13% market risk premium, then the noise gets even higher. 3.7%, let's say, times 2, that's like about 7%, 7.2%. So up and down, 20% down like 6%. What is a true market risk premium? We are even more unsure about it. But statistically speaking, longer time going back in history is always better. Okay? The estimate of market risk premium comes with a standard error, and then smaller standard error, better precision. That's the idea. Be consistent in your use of the risk-free rate. Since we argued for long-term bond rates, premium should be the 1 over T bond, and use the geometric premium if possible, because it is closer to the concept of compounded, investment, like your interest on interest kind of compounding idea. Okay. If you hold on to it and then don't sell it over and over, right? That's the idea. But geometric average also has its drawback, right? Geometric average. The idea was like, here's your starting point. You invested in T0 and up until T, big T, you are investing it. If you started and then ended up over here, what is the geometric compounded average growth rate, CAGR, right? That justifies this growth. That's the idea of geometric average, right? But what if you happen to end up with negative direction over here? Let's say this, right? Even though your index has been going up and then happen to tank in one single year, like financial crisis, 2009-8, right? The stock market has been going up, but all of a sudden it tanked like this. You will end up with negative market risk premium, right? Because you have to find out the compounded average growth rate to justify this decrease. It has to be a negative number. So that's a drawback. Well, if you take more risk, premium has to be positive. Why should it be negative? That's a drawback. Some more problems of using historical premium is survivorship bias. Survivorship bias. What is this about? Well, using historical data from the US equity markets over the 20th century does create a sampling bias. Well, if you take S&P 500 index, here's the idea. Okay, so here's the timeline, and 50 years ago, and then let's say there are about 6,000 to 10,000 companies in the US market. So many different stocks in the US market, many more in the whole world market, but S&P 500 are the most successful 500 companies, the biggest 500 companies out of the whole sample of 6,000. Okay? Now, 50 years ago, there was a company called Control Data. What is that company? After Second World War, during the Second World War, it was a war against Germany, right? You needed some code breakers who is good at German language and mathematics and computer. And that's why Minnesota people, okay, got involved over there because they were German heritage, German immigrants, and then they were well educated in math and speaking great English, clear English by the way. And then they worked in the computer for code breaking in the Second World War. And then after the war, they created a computer company called Control Data. And then that was making Cray computers, supercomputers. And it was even bigger than IBM, and it was the biggest computer companies like 50 years ago. That company was in perhaps this index, right? But nowadays it's nowhere. It's just taken over somewhere, okay? Disappeared. 10 years ago or 20 years ago, right? There was a company called Exxon, okay? Exxon, not Exxon, but Enron, whatever it's called, Enron. Energy trading company buying and selling electricity, right? Was perhaps number 3 in terms of Fortune 500 ranking. Biggest companies, obviously it was in the S&P 500 index, but eventually it went bankrupt because it turned out to be a fraud. The whole company was fraud. Nobody was trading it, but the CEOs they created some fake environment to show off as if they are doing it. Okay? They went bankrupt. They were obviously in the S&P 500 index, but they went bankrupt. At the time point of bankruptcy, your stock return has to be what? Minus 100%. And even before that, right, it disappears from the S&P 500. So, if you focus on these successful 500 companies only, would you include this minus 100% return for bankrupt company? And the answer is no. You're only focused on those successful guys, right? And making an inference based on these successful guys will be biased. That's called survivorship bias. Oh, here are the most successful guys. It's an interesting example story. There are 500 richest guys in the world, and we found out their common habit turns out to be meditation in the morning like this, yoga like that. So if we do the yoga like that every morning, would we be as much successful as they are? And the answer is what? No. We should have sampled throughout all the different population randomly, right? Maybe those people failed also trying yoga like this even more. So that's survivorship bias, selection bias, all these kind of things, right? Now, that's the one problem with historical measure. And risk premium for mature market, Here is geometric average approach. Given that there is standard error, I think this is arithmetic average. Forget about the geometric. Cross it out. Arithmetic average, US, UK, showing up over here. Right? So in your exercises later on, you can take the numbers from here. And then valuation of emerging market firms is a problem when you use historical premium. So far, the discount rates were estimated for the firms in developed markets. Firms in emerging markets are inevitably more risky. Okay, partly because there's more uncertainty, like geopolitical uncertainty and policy immaturity. For example, if you're valuing some North Korean business, you have obvious geopolitical reasons, right? South Korean companies as well, right? We have some North Korea related risk. If Kim Jong-un hits something, you know, some of these South Korean companies exposed to Kaesong business district, right? They get hit a lot. Policy immaturity is when your government officials switch randomly in terms of their policy. Oh, right now it seems like fourth industrial revolution seems sexy, so we'll put all the money into this, you know, AI-related business. All of a sudden, for some reason, the government officials get kicked out, and then you guys come in and say, "Oh, let's focus on agriculture. Forget about AI." And that kind of policy uncertainty, right, immaturity, is a problem. Maybe somewhere in developing countries, right, they will have their own policy maturity related issues. So don't we need some more risk premium related to that? Okay, and then for emerging market countries, we have short track record of financial markets. U.S. or European countries, their history, of financial market goes into like 100 years or 200 years quite easily. Okay. At one point, my RA was working on Argentinian stock market, and we found that the stock market started in 1870 something, right? 150 years. European stock market, further, right? Austrian market. But emerging market countries, right? Emerging market countries. In Korea, it's like what? 40 years history? Right? 40 years, even less. Anyway, so the standard error will be larger. Somehow we have to incorporate this kind of things. How can we incorporate risk coming from the fact that the firm has exposure to emerging markets? Especially if your company is in the emerging market, this problem. Number two, if your company is mature market company, okay, but more than half of your business comes from emerging market. For example, like your 100%, 50% of your revenue comes from Brazil, or 70% comes from Colombia. I don't know, Donald Trump will hate it, but 40% comes from Mexico. These kind of things. Don't we need some kind of country premium? Okay. So some people come up with the idea of country equity risk premium, but people don't agree sometimes. Okay. If you use global index that includes all these emerging market as well as mature market, do we really need that country risk premium? Okay. And some people use scenario-based approach in ICF. We're going to talk about these two, okay? Because these are touched upon frequently in the real world. The thing is, the first approach, country equity risk premium, I suggest you to use one simple approach over here, okay? Country equity risk premium, let's assume that's going to be default spread of the country, okay, and that's it. Default spread of the country's treasury, we learned about it before, right? To get to true risk-free rate of Korea, we had to subtract the default spread of Korea from the Korea's treasury rate, right? Default spread, we found it. Let's stick it back. That's the idea. That's because it's country-related risk, okay? And notice if you do the math, you realize this country's treasury rate itself. Okay, we are just naming it differently. Now, some textbooks, okay, try all different kinds of ways to estimate country equity risk premium. I'm not going to test on this one. Don't worry about it. This is for your reading pleasure. Okay? How to incorporate country equity risk premium. Our approach will be simplest one over here. That's it. If you don't like country equity risk premium approach, there is an alternative way, which is scenario-based approach. Okay? Scenario, what do you need? Good state and bad state. Okay? So, project cash flows under assumption of normal business situation and estimate the value of the company. The other is bad state. Project cash flow under the assumption of bad business situation. Sorry, this is just to check whether you are awake or not. Bad business situation, and then estimate the value using the same discount rate. Now, that will be called VD because it's downside. Now, assign probability of having distress or bad side, and the other outcome, the probability will be 1 minus P, obviously, and then the weighted average of these two values will be your company's value. That's the idea. Can you give me some example? Okay, here's one company called